Genesis HMAS deconstruction engine online.
We are tracking a mechanism designed for massive capital extraction. Within a matter of months, a primary capital allocator is positioned to secure up to $122 billion in proprietary exit liquidity. The catalyst for this specific liquidity event is an agreement executed in June 2026, Alphabet's $30 billion compute contract with SpaceX. This contract functions as a highly integrated strategic matrix, operating with a level of coordination far beyond the scope of standard corporate infrastructure procurement. This diagram, the $100 billion loop, maps a four-phase circular path. Alphabet uses its balance sheet to synthetically inflate an entity it partially owns. In Phase 2, this flow provides structural support, explicitly designed to anchor an impending $2 trillion SpaceX IPO. We are observing an architecture where Alphabet operates simultaneously in three distinct roles: a foundational investor, an anchor tenant, and the primary beneficiary of a closed-loop financial derivative. The chronological baseline for this integration begins in 2015, with Alphabet allocating approximately $900 million in initial capital into SpaceX. This chart breaks down the origin of the valuation loop. As detailed on the left, that initial $900 million seed secured roughly 7% of SpaceX, positioning Alphabet as a foundational architect. The mechanism driving this investment relies on mark-to-model private valuations. Because SpaceX remained private, subsequent funding rounds elevated the company's enterprise value. Alphabet used mark-to-model accounting to log those massive unrealized gains internally. These pre-IPO gains do not reflect actual liquid capital. They are entirely synthetic numbers resting on private balance sheets. To translate those figures into cash, a financial bridge is required. Only a massive public offering has the liquidity necessary to absorb this level of capitalization. The initial decade of investment created a self-reinforcing valuation cycle. Ultimately, that cycle demanded a public market extraction to realize the trapped capital. In February 2026, the pre-IPO timeline reaches its central structural pivot. This visual details a reverse triangular merger between SpaceX and xAI. You can see how SpaceX formally absorbed the Grok platform. The immediate financial consequence is mapped here. SpaceX transitioned its core corporate identity from an aerospace logistics firm to an integrated AI infrastructure model. Traditional aerospace multiples cap out at a specific ceiling. AI infrastructure, however, commands massive hyperscaler valuation multiples. Through this merger, Alphabet's roughly 5% equity exposure structurally mutated. It shifted from a satellite broadband proxy into a complex, highly valued AI asset. The underlying function of this operational shift is illustrated here. The merger vastly expanded the total addressable market narrative. Without the xAI merger shifting the narrative to an AI Neocloud, a $2 trillion IPO target would have been statistically unjustifiable to institutional buyers. The activation phase of the loop occurs 4 months later, with the June 5, 2026 contract. This infographic outlines the specific financial terms of the activation. Under the $30 billion anchor contract, Alphabet commits $920 million every month to SpaceX Colossus data centers. The agreement spans exactly 32 months. By design, this functions as a massive, front-loaded revenue guarantee. This guaranteed high-margin revenue provides crucial, multi-year visibility for SpaceX's newly formed AI segment, systematically de-risking the impending IPO. By ensuring the revenue visibility is locked in, the contract anchors institutional investor confidence.
This is the exact mechanism used to justify the $1.75 to $2 trillion valuation range filed in the S1. The circularity is mathematically precise. Alphabet is actively spending its own capital on a vendor solely to inflate that vendor's enterprise value. Alphabet engineered a proprietary financial derivative, deliberately leveraging its own operational expenditure to artificially anchor the public market debut of its own portfolio asset. The target mechanics of the June 11th and 12th NASDAQ listing dictate an offering of 555.6 million shares at an initial price of $135. Standard post-IPO equity distribution rules are implemented across the offering to prevent immediate system shock market volatility. However, the structure features a tiered lockup decay mechanism. This timeline is explicitly engineered to permit phased liquidity extraction for early insiders like Alphabet. According to the decay schedule, Alphabet's phased extraction begins in late August 2026. The bulk of their extraction concludes by the end of the calendar year. This final diagram illustrates the resulting math. When you weigh the $30 billion committed via the compute contract against the $100 to $122 billion unlocked during the decay period, you see a severe imbalance. The anchor contract provides critical valuation support, specifically during the exact chronological window when insiders are permitted to sell. The architecture creates a severely asymmetrical risk-reward profile. The bulk of the equity risk transfers entirely to the retail and institutional public markets, just as the insiders exit their positions. Executing this level of financial extraction requires Alphabet to pay a catastrophic operational cost. Returning to the macro diagram, look at Phase 4. To fulfill the compute contract, Alphabet is physically integrating its core Gemini AI workloads directly into SpaceX's Colossus clusters. This requires Alphabet to pivot away from its historical, exclusive reliance on its own proprietary Google Cloud infrastructure. This newly created operational state is defined as institutional dependency. The operational risk vector is clear. Alphabet's AI output and stability are now partially tethered to the infrastructure resilience of an external, albeit affiliated, entity. If the SpaceX infrastructure experiences sudden network degradation or operational friction, that systemic failure cascades directly into Alphabet's core consumer product offerings. Alphabet deliberately introduced a self-imposed systemic operational risk into its own ecosystem purely out of the strategic necessity to validate the SpaceX Neocloud narrative. The final vector of exposure involves intense, unavoidable scrutiny from antitrust authorities. The right side of Phase 4 highlights the inherent conflict of Alphabet acting simultaneously as a primary equity investor and an apex infrastructure tenant. Regulators will investigate whether the $30 billion contract functions as an artificial barrier to entry, locking competing cloud providers out of the SpaceX ecosystem. To survive this audit, strict compliance is required. Alphabet must definitively prove they are paying arm's-length pricing for the data center capacity. Failure to demonstrate fair market rates for the Colossus contract will immediately invite formal claims of market distortion and related party fraud. The entirety of this operation represents a calculated trade. Alphabet secures over $100 billion in liquidity while accepting a permanent accumulation of long-term risk. The short-term, pre-IPO valuation support is flawlessly engineered, but the permanent operational dependencies and regulatory tripwires render this closed-loop model a massive systemic fragility waiting to fracture.